Thank you, Carol, and thank you, Ken, and the Institute. It's nothing like getting a build-up like that and then have to come up and tell you. So, as Carol mentioned, I live outside of Chicago, and when I got up 2 days ago, there was a foot of snow on the ground. So when I tell you I am happy to be here, I truly mean it. I look around the room and see, boy, the power of free food in a free-falling market. That is a powerful draw, isn't it? What I'd like to talk to you about tonight is the stock market and your investments. And I'm going to do it in about 4 pieces. First, the first piece is I'm going to talk a little bit about how we got to where we are, because I think it's important to kind of understand. I think a lot of us feel like we've been run over by a freight train and didn't even know where the freight train came from. And I think it's also important to kind of understand the backdrop of how we got here, because partially we're going to have to work through that to get out. The second piece of it is I'll give you an idea where we are today, what I am seeing, what I think is going to happen. I'll talk about a path out, things that I think we'll need to see as investors in order to give me an idea of that $64,000 question, has this market bottomed? Finally, we'll talk about what I think individual investors should be doing. And then finally, I'll give you a couple of stock ideas. Now, I've done this enough where usually when I get to the final stock ideas, pens wake, paper comes out, people wake up, and one of these days all I'm going to do is sit up here and give you, stock ideas for 50 minutes. You're not going to get that tonight. You're going to have to endure a little bit different till we get to that. So how did we get to where we are today? And again, this is not meant to be political. It's not meant to finger point. Trust me, there's enough blame to go around for everybody. But in a nutshell, as I see it, we got to where we are today. First and foremost, this has been built on the back of a housing bubble, pure and simple. A housing bubble that was driven by easy credit and a push in this country for home ownership. Why do I say that? When you look at mortgages in 2002, the total percent of mortgages that were subprime mortgages of all mortgages was 2% in 2002. 4 years later, it was 30%. 30%. So what you had, in effect, was this huge growth in mortgages made to, for lack of a better term, credit-challenged individuals, or individuals taking advantage of those opportunities because they were available to them, all based on the premise that my housing value is going to continue to rise. So what Wall Street did in its infinite wisdom is take these subprime mortgages, package them up. After all, if one of these mortgages might be a little bit risky, but boy, if I package 11 or 12 of them together and slice and dice them up, well, all of a sudden, that's diversification. And what one was bad, 12 of them are great. And the credit agencies do what? They give them AAA ratings. Well, if you think about it, that's not really what diversification is all about. Diversification means you take non-correlated assets and put them together in a portfolio, or assets you hope are non-correlated. And we're finding out maybe diversification is a little bit flawed this time around too. But ideally, you take non-correlated assets. Here, it's kind of like saying, listen, I got one bad baseball player, and that's a bad thing. But boy, if I can stick 8 bad baseball players together, and trust me, I'm from Chicago, so I've seen plenty of 9 bad baseball players. So you put 9 bad baseball players together, and boy, we got a great team. Well, doesn't quite work that way in baseball, and it didn't work that way when you were securitizing these subprime mortgages. So what happens is Wall Street takes them. They got a great product, AAA rating, great yields in low yield environments, boom, shooting them off all over the world, selling them everywhere, not just in the United States, but literally all over the globe. So you got banks buying these things, you've got insurance companies buying these things, you have hedge funds buying these things, you have investment banks owning these things. So now they're out there and they're on everybody's balance sheets. So now what happens? The bubble bursts. Housing values start to decline. People who bought are now finding that their mortgages are underwater. They can't pay their mortgages. They're walking away from their mortgages. That concept of jingle mail, if I have any bankers in the room, you know what jingle mail is? Where you get the envelope in the mail, and what it is, it's the person keys to the house, because in the age of non-recourse loans, why should I sit there and I got a house, I owe $700,000 on a house that's worth $400,000. What's the rational, logical thing I'm going to do? Here are your keys. So what happens is all those securities out there that are based on these mortgages, they start to lose value, and they're losing value quickly. That sets off a massive chain of events. Well, one of the chain of events it sets off is, remember, these mortgages are on banks' books. And banks have capital requirements. So now their capital is shrinking because of these things. What does that mean for banks and other entities that have capital requirements? They got to get capital. Well, how do you get capital? Well, you go borrow it from somebody. Well, who am I going to borrow it from? The guy down the street's in the same boat I am, and he usually is the one that gives me the money, and he's not giving me the money right now. And I can't get it from him, and I can't get it from him, so what do? Well, you get into a situation where nobody's loaning out and everybody's hoarding. So what else can you do to try to get your capital back? Well, I go back to the people that I loan money to, based on collateral, based on these things, that's now declining in value, and I say, you know what, I gave you the money based on this value ain't the value anymore, I want my money back. So that sets off a chain of events, and that's why you're seeing such entities as investment banks and hedge funds and these entities that run their businesses on tremendous amounts of leverage. In the case of a Lehman Brothers, for example, you know, one of the things that's interesting about what happened to Lehman Brothers is what happened to it so fast. But if you're a business that's basically run on 15 to 20 to 1 leverage, where for every capital dollar you have, you've gone out and borrowed $15 or $20 to run your business, you are running a business based on promises and the friendliness of your local banker or loan person, somebody giving you money. Maybe the credit markets, maybe investors. Everybody is shut down at this point. So now what do you got to do when the bank's calling the loans and you have to deleverage? You sell. And you don't care what you sell. You know, when people tell, and I was having this conversation earlier this evening, and said, boy, it looks like some of the stocks that are really getting whacked around the most are some of the best companies out there. Companies that you know aren't going bankrupt. Companies that are solid companies. They're still making profits. And you know what? Nobody cares. And the reason is, in an environment where you have to sell because you got a banker staring at you, or you have investors lined up your door that want their money back because they're not pleased with their performance, and you got to sell, you're not going to care at what price you're selling, and the first stuff to go is the stuff that can sell. So, and oftentimes the stuff that can sell is the biggest, largest, bluest chip, deepest markets, and that's what's getting pitched. So now you have this tremendous deleveraging that's going on in the economy. You've got everybody that's eschewing debt. They're getting off debt. They're getting off debt because they're being driven to get off debt, and they're selling. And again, it's fairly indiscriminate. And one reason you can tell this notion of indiscriminate selling, this notion of proportional selling, if you will, is that if you look at the uniformity of declines across asset classes, I've never seen anything like it. And I've been doing this since 1926. I came down and drank the water in Florida down here and got the... I've been doing this since 1982. It's kind of interesting. I saw in here the notion that, you know, a person today is going to have about 900 jobs in their career. I'm a rarity. It's the only place I've ever worked. I've been there for 26 years. I started my second day on the job, and I look around the room and see I'm not the only one here that's got gray hair, so this may resonate with some people. I started on the job August 16th, 1982. On August 17th, 1982, it was a Tuesday, I came into my office and the Dow Jones Industrial Average went up 39 points. Big deal, right? Well, it was a big deal. The Dow at that time was 792. So, went up 5%, and some people pegged the beginning, literally, of the bull market, the great bull market of the 1980s and 1990s, based on that day. So, when all of you were thinking back to those wonderful days of past, when you were making all that money in the market, in the 80s and in the 90s, you're welcome. But you're seeing selling now, getting back to that point. The uniformity of the selling I've never seen, and I've been doing this for 26 years. How do I see that uniformity? Look at any asset class you want to look at, particularly across equities. You look at large cap stocks, mid cap stocks, small cap stocks, value stocks, growth stocks, US stocks, international stocks. Everything is down 35, 45%. Everything. It's remarkable the tight correlation of returns across those asset classes. You know, the old adage is, you know, somewhere there's a bull market. There ain't been a bull market anywhere this year. There's been no place to hide. You look at commodities. They've been getting creamed. You know, you look at the bond market, it's not down 30 or 35%, but you've got short-term bond funds that are down 9%, 10%, 15%. So everything is just getting hammered this year. And one of the reasons everything is getting hammered is because of, to some extent, this forced selling that's going on in the market. There's great deleveraging, there's great unwind. So that's one aspect of what's brought this selling pressure into the market. Now, keeping this analogy going, as I mentioned to you, one of the things that happened to cause all this was a decline in housing prices. Well, the decline in housing prices has a huge impact on everybody in this room in terms of the wealth effect, how you feel about your wealth, how much money you have. And you've got a decline. And the other thing is, and I'm not pointing fingers at anybody in this room because I'm sure everybody in this room, nobody has done this, but you know, there are a few people in the United States that actually refinanced their homes a time or two or 12. And during each of those refinancings, what were they doing? They were pulling money out. And what were they doing with that money? They were funding consumer spending. Well, that game's over. Not entirely over, but it's over to the standpoint that everybody can play the game anymore. So consequently, you have consumers that aren't spending right now. Well, consumer spending is one of the biggest drivers of the overall economy. So if you don't have consumer spending, what's that doing to corporate profits? Well, we're seeing what's doing to corporate profits. You've got, you know, the Circuit Cities of the world filing Chapter 11. You've got the Best Buys of the world saying, we've never seen an environment like this. You've got technology companies that depend on consumers as well as corporate expenditures that are pulling in their horns. Consequently, you're getting corporate profits are getting creamed, and they're going to continue to get creamed. Stock prices generally, most of the time, historically, are driven by corporate profits. So now you've got declining corporate profits. That's another factor coming in, making investors sell. I'm going to pause here while you throw up. So that's how we got to where we are now. Okay? You've got housing bubble, fueling deleveraging in the market. Investors have to sell. Consumers restricted now by that pop in the housing bubble, affecting corporate profits. Corporate profits are going down. That affects the economy. And again, the one distinguishing fact here, too, it's not just a U.S. phenomenon. Again, these things are sold all over the world. So you're seeing Asia down. You're seeing Europe down. You're seeing the Middle East down. You're reading things in the paper now about, the country of Kuwait is having a financial problem. Some of these Middle Eastern things that, they roll in cash are having liquidity crises right now. So that's how we got to where we are. Now, that's not really what you came to listen to. It's like, what do we do now to get out of this? What do we need to see? What's going to happen? Well, I think first and foremost, you need to think about the economy and you need to think about the stock market. I don't want to say it's two separate things, but the question isn't, is the economy going to get worse? It is. The question as an investor, I think, is has the stock market discounted 50%, 75%, 100% of what we're about to see? Keep in mind, there's so much uncertainty out there. But the one thing I know for certain is this. The S&P 500 is down about 45% from where it was 13 months ago. That I know for sure. We're on track to have, I think, the worst year in the stock market since 1931. Now, has that discounted 100% of the market? 50% of that economic problem? I'd like to think it's discounted a pretty good chunk of it. Hopefully all of it. We'll find out. One of the things we kind of need to see, I think, before you can kind of say, you got a lot of people out there saying, well, the market's bottom, or the next level is 7,500, or the next level is whatever. The fact of the matter is nobody knows for sure. And a lot of times that historical, the market's going to bottom or the next resistance point 7,500, they're only looking at where it stopped at last time. And is this time going to be different or is this time not going to be different? We'll find out. Had you said to me 2 days ago the market was going to fall 850 points in 2 days while I was in lovely Pensacola, I probably wouldn't have come and taken my chances staying in snowy Chicago, see if it would have changed my luck. Of course it wouldn't. So that's the question, is it discounted that? Now, one of the things I'm trying to see is I'm looking at the market to try to get a sense of whether this market is bottomed or close to a bottom or whatever. I'm looking at a couple of things and trying to get a perspective, and that's an important word in this market environment, perspective. So many of us feel kind of like that leaf in the wind that's just blowing all over the place. And, things we believed have been shattered, ideals we held about investing have been shattered, and it is. And I'd be lying if I said that, I haven't been worried at all of what's going on in this market. This has been a market. You see it Don't take my word for it. Take all the sovereign wealth countries that were coming in and investing in the financials 6 to 8 months ago at prices significantly higher than they are today. Take some of the, quote, smart money people that invested in stocks and 6 months ago that are now sitting with 50 and 60 and 70% losses. Take, the genius of all time, Warren Buffett, and see what he's invested in. And boy, don't we love GE at 20, and it's 13 today. So, there's room for feeling dumb all over the place, okay? But one of the things you got to see, I think, when you have a market that's bottoming, this is going to sound silly, but you need stocks to stop going down. There's wisdom in that statement. You need stocks to stop going down in bad news, okay? One of the things you need to see is this cavalcade of bad news that comes out, and all of a sudden you stop seeing stocks react to that negatively. That's when you have more of a feeling that stocks are discounting what's going on. We haven't had that yet. I'd like to think we're going to get pretty close. We're close there, I think, but we haven't seen that yet. We're going to get a good bout and a good test of it, I guarantee you, over the next 3 to 6 months. There's still plenty of shoes that can drop on this market. Hopefully the market's aware of that and has discounted it. But, the next crisis is probably going to be what? Credit card debt. Consumers failing out. You're seeing that already with, with the American Expresses of the world, what the Targets are saying about their credit cards. That's probably the next big shoe. Then there's obviously, you had this consumer, the residential real estate, what's going to happen to the commercial real estate, where you're starting to see that. So, when you sit there and give me the litany of like, Chuck, look out the window. How can anything ever get any better right now? It's hard for me to dispute that, but I will tell you that if you wait for the all-clear sign, and I have clients tell me all this, we're just going to kind of ride this out, and then when things look better, we're going to get back in the market. Well, in theory, that sounds really good. And if you know when things are going to get better, make sure you blow me a call so I can get back in. One thing I am certain, when the market turns and turns in earnest, it's not going to be when things are really, all roses, because you're going to, and this gets back to this notion of catalyst. I hear people now, I just can't see how this market could get better. The economic news is so bad, what's the catalyst? What's the catalyst? What's the catalyst? Well, I can tell you, again, in my 26 years in investing, a lot of times you don't know what the catalyst is until 6 months later because the market's forward-looking. And so now the market kicks up, you're sitting there and you're going to read about it in the newspaper like, well, the market's moving, but it really shouldn't because the economic picture is still lousy. And then 6 months later you see, well, maybe corporate profits have improved. Maybe there's, the housing market has started to improve in areas of the country. You'd never really know quite what it is. I think ultimately what happens, though, and how we get out from where we are now, and why you generally see huge explosions upward following such, excuse my French, crappy markets, is because the market is driven by expectations. And many of you that have probably owned stocks have seen this. Company comes out and their earnings are up 30% and the stock goes down 10%. And you're sitting there going, yeah, 30% seemed like it was a pretty good gain. Well, it didn't meet the expectations. Markets are driven by expectations. So what will happen, and it will happen this time, is just trying to figure out when that's going to occur. If you're looking for a catalyst, the catalyst ultimately will be the news isn't as bad as you think it was. Things beat expectations. You can see it with corporate profits, and it usually starts with corporate profits, and the cycle is pretty similar, and it will occur again. Keep in mind, all these companies are producing really bad corporate profits right now, and it's probably going to be the case for the next 2, 3, 4 quarters. They're going to have lousy corporate profits. But all those periods of lousy corporate profits are setting up what? Easy comparisons. 12 months later, 18 months later. And again, in 18 months, 24 months, markets move generally 6 months in advance of an end of a recession. So now you may be looking at mid-2009 toward the end of 2009 before you really have a market moving higher in earnest. That doesn't necessarily mean that the market has to continue to tank, but you may get into kind of a choppy, ugly market probing for a bottom, and it does that for the next 12 months. That's entirely possible. Now, if we go back to what happened after 9/11, and again, I'm not comparing situations per se because the drivers are different, but just as what could happen in terms of having to wait. After 9/11, what happened in the stock market? Well, the market was closed for a few days after 9/11. When it opened up, what happened? Shoot. It tanked. Then, interestingly, what happened? The market took off in early 2002 and had a real nice move up until the fall of 2002. And then what happened? Zoom. And then what happened then? Well, in 2003, the beginning of 2003, it took off, and then it went on for a nice 4-year run. Had you bought in stocks right after the market tanked, after 9/11, and I'm going to show you some data here, why that would have made some sense to do that, based on historical precedent, based on historical things. You may not have been ultimately rewarded for another 12 to 14 months before that buying took off. And I think that's kind of where we are right now. You know, I don't know if you buy today, if you're going to get rewarded for that over the next day or two or 5 or 6 or the next 2 or 3 weeks. I don't have a high degree of confidence in telling you. I do have a high degree of confidence in telling you that I think in 2 to 3 years you're going to be glad you did. And I also have a high degree of confidence telling you that because of something that I want to show you. You have a, on your handout here, I'm going to walk you through a tool that my firm uses to give me an assessment, and you an assessment, of popularity of stocks. Or, if you twist that around, of pessimism in the stock market. The idea as an investor ultimately is to buy low and sell high. Unfortunately, nobody ever wants to do that because to buy low means you got to buy damaged goods, and nobody wants to do that. Stock market's the only market in the world. People love to buy the merchandise as it gets more expensive. It's true. Because we all like to feel like we're getting validation, and nobody wants to step out of the herd, and so forth. So nobody ever wants to buy low and sell high. But ultimately, if you think of it rationally and not reactively, you want to own stocks at that maximum point of pessimism. Because generally, that's where the values are the ultimate things. When nobody wants to own, that's where the values are. Well, how do you measure pessimism in the market? How do you try to get a sense of popularity of stocks? This tool, the Intermediate Potential Risk Indicator that's in your handout, in 26 years, it's the best thing that I've ever come across for giving me a perspective, there's that word again, perspective, on where we are in the market relative to where we have been relative to a pessimism level, a popularity of stocks. Now, as you can see by the verbiage on the chart, this chart looks at the percentage of stocks on the New York Stock Exchange that trade above their 200-day moving average. Why does anybody care about a 200-day moving average? What is a 200-day moving average? Well, a stock's 200-day moving average is simply this. Take 200 trading days, take an average of that, that's a point on a line. To get the next point on the line, you drop a day, add a day, take the average, that's a point, and so forth. So I like to use a stock's 200-day moving average line as kind of an equilibrium, long-run, average price level, equilibrium price level for a stock. Again, no tool's infallible, and I'm sure there are people that can pick apart what I'm about to say. But in essence, as an investor, what you're trying to do is get a perspective and use tools that are A, easy to find, B, that are simple, and C, that I think do have merit and historically have demonstrated that merit. So I like to look at a stock's 200-day moving average as a group to try to give me some sense of the value of that stock as a group. Why a 200-day moving average? Why an equilibrium price? Why does that matter to anything? Well, I'm kind of a believer in this concept of reversion to the mean. And reversion to the mean says that on a short run time, you can have things that run to extremes. But over the long run, things tend to migrate back toward, they don't have to be an equilibrium, flatline, steady state, but they tend to migrate back to some equilibrium level, some golden mean, some steady state. Think weather. You have hurricanes, you have tornadoes, you've got snowstorms, you've got things. But over time, weather patterns generally, depending on where you are in the country, you have an equilibrium level. Why don't they remain at those extremes? Because it takes too much energy, and the energy has to dissipate. And then we call back to an equilibrium. Think human emotions. Weddings, births, deaths, divorces, 400-point down days in the market. We don't live at those extremes, though. Why? We'd be exhausted. Over time, we have some sort of equilibrium level that we live our lives at. Now, I will grant you, people's equilibrium levels will differ from others. But there is some level that we live our lives at. I think there's an element of that goes in stock prices, because I think stock prices, and again, I went to the University of Chicago, which is the bed of the efficient markets there. So, but I also believe that you can have behavioral issues that affect stocks, and on a short-run basis, things can kind of get out of whack a little bit. because of fear and all those things that are causing everybody in this room to think whether they should stay in the market, quite honestly. So you can have things that move to extremes in the short run, but I think over time, as a group, you will have stocks tend to migrate back. They don't have to necessarily get to the equilibrium or stay at the equilibrium, but they're going to migrate back to that. So we've tried to quantify that over the years at my firm by looking at a percentage and saying, you know what represents a lot of popularity in stocks and what represents really pessimism. So over the years, we've said that anytime 70% or more of the stocks on the New York Stock Exchange are trading above their 200-day moving average, or trading above this equilibrium level, stocks are pretty pricey. They're pretty popular, probably close to being pretty fully valued, and probably ready to drift back down to that equilibrium level. Doesn't have to happen the next day it gets to 70%. Again, a lot of times people love to use these tools on Wall Street like with laser precision, and sometimes they are somewhat blunt instruments where you just are trying to get a perspective on things. Conversely, when you see 40% or lower of the stocks on the New York Stock Exchange trading above their 200-day moving average, in other words, when 60% or more of the stocks are trading below that equilibrium level, history has shown that over time they will tend to migrate back up to that level. Again, this is the best tool that I've ever used and we've ever used to try to get some perspective on the current market conditions. And what I like about this tool is that it's a relative tool in a sense. It doesn't depend on, so many of us have these hard and fast rules of investing. I don't buy stocks unless the PE ratio is 4, or I don't buy stocks unless the yield is 3. Well, those things can change in market environments, but this is a relative tool that you can look back over time for comparison purposes. So we followed this daily since 1989. There have been a few instances when the percentage went below 20%. One of those instances was back right after 9/11. As you can see, back in 2001, it dipped down to about 19%. Looks in 1998, it also dipped down to about 15, 16%. So there have been a few times. The times that it's gone below 20% historically for us in that some 20-year period, stocks have really come back very strongly, and they've done it in relatively short order. The lowest I've ever seen this percentage, and again, we're trying to get a perspective here on pessimism in the marketplace. The lowest I've ever seen this percentage prior to the recent correction was 10%. As you can see here, it says it's 3%. And actually, I did this 2 days ago. So it's going into today, it was 2%. Okay, 2%. I've never seen it that low. Now, this concerns me. I take away two things from this. First, I've never seen stocks and I've never seen a market priced like this before. Okay? I've never seen it this cheap before. I've never seen values in an opportunity based on this history. I've never seen it like that. So I have to factor that into my plan. On the other hand, the fact that we have gone to such extremes here kind of also lets me think a little bit that things have kind of come off the rails a little bit. Now, I can tell you that at some point, values will matter to stock market. Ultimately, profits will matter to the stock market. I'm certain of that. What I'm not certain about is when it will start to matter and how low that'll get. However, I look at this. By the way, the other slide on the back is the New York Stock Exchange composite. Okay? And on that, you see where I circled 3%. I circled where that percentage is available. Actually, this percentage, and one reason I really like this tool and its usefulness is that anybody in this room can get it every day for the price of a newspaper. You can find it in Investors Business Daily, which is a daily newspaper. Now, I don't work for them. They don't know who I am. I don't make a buck off Investors Business Daily. I'm not shilling this. But it's the only place I've ever found where you can find that simple statistic every day. And so I made a copy of the page that it's on. It's always on this New York Stock Exchange composite chart. And 4 out of the 5 days, it's on page B2. B as in boy 2. On Monday, they hide it, and it's harder to find, and don't ask me why, but they do. But 4 out of the 5 days you can find on B2. So if you want to continue to track this and see, and again, single best thing I've ever used. But so I look at this and say, boy, stocks are cheap. I look through my experience and say, you know, when I first started in 1982, I can remember talking about stocks and writing up stocks and saying, boy, this stock is expensive because its PE ratio is 8, if any of you can remember back to 1982. Well, I'm starting to see a lot of the same things that I saw back then. I'm starting to see stocks with yields of 5% that aren't financial stocks, that aren't going to cut their dividends, that have plenty of cash. Some of the things that I used to see back then when stocks were really, really cheap. So I'm sitting there thinking, 2% of the stocks looks really cheap. What I'm seeing in the marketplace. Then flip over to the last page, the Dow Jones chart of the Dow Jones Industrial Average. This is your kind of classic half full, the glass is half full or glass is half empty kind of a chart. I'm kind of a glass is half full kind of guy. So I look at that and say, you know what? And keep in mind, we're back to 7,500 after this was done 2 days ago. So we're at 7,500. So on the one hand, I say, boy, my valuation, some of the best indicators I've ever used say stocks are really, really cheap. Just looking at my eyes and looking at valuations, I think stocks are really, really cheap. Yeah, I'm aware maybe this is the greatest value trap in the history of mankind, but the other thing I know for certain, what do we know? Market's already down 45%. Then I look at this chart and say, you know what? We just gave back 10 years of stock market returns. 10 years. Now, that's a sobering fact, too. But it is what it is, and we've given back 10 years. So now I go, you know what? Stocks are cheap based on my tools. I'm looking with my eyes and valuations. I'm seeing yields I've never seen before on good quality companies, not these 20% yields that are thorough and they're not going to be there. But I mean 5% yields on companies that got plenty of cash and no debt and all that good stuff. And then I look at this and say, you know, we've reverted back 10 years. Yeah, we had a gay old time in the 80s and the 90s. 1990 stocks are going up 18% a year. I know, let's pause and wipe a tear of our eyes on the good 1990s. But, you know, this reversion to the mean, we've given up 10 years. We're going to give up another 10 years? We're going to get back down to 5,000, 2,500? I don't know. But as an investor, I got to play probabilities, because that's all I got. I can sit here and guess, but I have to do something at the end of the day. I have to do something with my investments at the end of the day. And what am I going to do? I'm going to try to play some probabilities. Now, let's get to what I think you should be doing as investors. I think the first thing you should be doing is staying engaged in the process. And as simple as that sounds, and as obvious as that sounds, I guarantee you there are people in this room that refuse to open up their statements from October. Yeah, you talk about a Stephen King novel. It's terrible. All right? November so far is not going to be much worse, or might be much better, by the way, and it's going to probably be a little bit worse. But you have to stay engaged in the process. The reason is what you do in your portfolio now is what's going to drive returns 2, 3, 4, 5, 10 years from now. And I look around the room, and as best as I could tell, most everybody in here has still a good 10, 15 years. Maybe with the exception of that one gentleman in the back. But other than that, you've got 10, 15 good years left, okay? And what you do today is going to depend on what happens tomorrow. So some people go, you know, I tell people this and they go, well, Chuck, I don't have any money. I'd love to be buying stocks. They're cheap. I don't have any money. I'm all in. Okay. Well, you have some money in the market right now, and you've got a portfolio right now. And this gets to my second point. You've got to look forward. You can't look back. This has been the classic Monday morning quarterback market. And everybody's sitting there going, I had X, and now I got 0. And I can't believe it. And you're basing investment decisions now looking at the rearview mirror. I got news for you. They're not going to change anything. We are where we are. And what you do right now with that portfolio you have, again, is going to determine what happens 5, 10 years from now. So what should you do? I think you can do 2 things as an investor right now. Yeah, if you want to play some defense, I don't think that's the worst thing in the world. We manage portfolios for individuals, and to put some meat on the bones of what I mean by playing defense is this. Right now, in a portfolio that we have that's an all-equity portfolio, we're holding anywhere from 25 to 35% cash. Now, that's a lot of cash for us. I got clients that say, well, you know what, it wasn't enough cash. In hindsight being 20/20, you know it wasn't. But I also know the risks of holding a lot of cash. And I also know the risks of this all-or-nothing market timing. Because I guarantee you, if you got blown up on the way down, you miss it back on the way up, you're going to be really mad. So if you're trying to calibrate things, what we're saying is defense is 25 to 35% in all equity portfolio, and you can apply that proportionately if you're somebody that says, you know what, I've capped my equity exposure because of my age, risk restraints, et cetera. It's 60%. So in that world, the portfolios that we have like that, we're running at 60% times 65%, which there are a lot of people who do math a lot better than I do in the top of my head, but that's somewhere around 40%. So if you were a 60% max investor in the market, we're running around 40%. Play defense. But the second thing you really need to be doing is making sure that your portfolio is positioned in your very best investment ideas. You really need to do that. You need to go through, and that's what you do. If you don't have new money to buy, okay, I get that, but there's no excuse for not making sure that your portfolio isn't positioned to benefit with your very best ideas going forward. And I guarantee you, have we had this discussion 18 months ago, you were probably seeing, boy, that stock, I always wanted to get in my portfolio, but it was always too expensive. Well, it ain't expensive anymore. Get it in there. And if you got to sell something, sell it. And if you got to sell something that you wrote down 50%, sell it. Okay? The fact that it went down 50%, the stock doesn't care about that. It's not sitting there going, well, I came down 50%. I'm going to go back up. It doesn't care. You got to live in the moment. You got to live now looking forward. And if you have something in your portfolio that is down and is no longer among your best investment ideas, get rid of it and get something else in there. Conversely, maybe you have written something down. But when you're in the light of day, in a rational moment, not after a market's down 450 points in a day, you sit and look at your portfolio and you go, you know what? I think going forward over the next 12 months, this is a stock that can make me money relative to all the other options out there, then keep it in your portfolio. And if you have money, buy it. But again, I think those are the things that investors really need to be doing right now. Yeah, play defense, and that defense, by the way, is going to be different for people depending on, all that stuff about time horizons, restraints. I've had conversations with clients, and as much as they have said, you know what, I think stocks are cheap, but I'm at the point in my life when, preservation is really all that matters to me now. Because I've calibrated it out, I want to retire in 12 months, and this is what I need to retire. And this is what I'm going to have to earn off this retirement, and I've drawn the line in the sand that said this is the amount. If it goes below that amount, hey, I'm going to miss the opportunity cost. But if it goes below that, if it goes way above that, I'm going to miss the opportunity cost. If it goes below that, I'm living with my kids. And yeah, you thought you were scared. So I understand that notion, and it's always tough for somebody in my shoes to come up here and tell everybody what, you ought to have 35% in cash and stuff, because everybody in this room is a little bit different. But again, if you're using a benchmark, we're about 35% in cash. The third thing you really need to do as an investor is figure out a way that's palatable for you to put money into the stock market right now. And what do I mean by palatable? Well, I know if I go up to somebody and they say, well, you know what, I got 25 grand, burn a hole in my pocket, I want to get in stocks, they're not going to put that in the market right now. I mean, maybe they will, but they're a whole lot braver than 99.9% of the people in the world. You're just not going to do it. So what happens? You never get it in, because here's the rationale that happens. The market goes up, what do you do? Well, I can't put it in now. Stocks are going up and they're going to come back down. So the market goes down, what do? I can't put it in now. Stocks are getting cheaper and they're going to get cheaper. You never get in. So figure out a way that's palatable to take advantage of the opportunities there. Yeah, you may not be rewarded for those opportunities immediately, but you got to figure out a way to do that. And two ways that work out really well for people are the 401k, 403b type style of investing, where maybe you've taken that lump of money that you've already accumulated and you've diversified that in a way that makes sense for you. Maybe you've become a bit defensive with those funds. I get that. But you still have that money that's being contributed on a regular basis coming out of your pay that you have the ability to adjust that to. And if you've pulled in the horns with that money, I think you're making a mistake. So that's one way that's palatable. Yeah, it's not all in. It's not trying to figure out that time that you're never going to do it. But you figured out a way to get money into the market. I think the 401ks, 403bs are perfect for that. I think anybody that still has a reasonable investment time horizon should really be looking at the contributions they're making into the plan and how those contributions are being made and adjust those. Most plans will allow you to have a different allocation for the contributions versus a different allocation for the lump sum that's in there, and you have to take advantage of that. The other way that I think is palatable is a way that's kind of near and dear to my heart, and it's based on this concept of dividend reinvestment plans, where dividend reinvestment plans are programs that allow investors to buy stock directly from the company. I apologize if there's stockbrokers in the room. This is not meant to besmirch you. It's just giving an opportunity. My experience has been, quite honestly, stockbrokers don't want these people. Okay? But if you're trying to think of a way, whether it's dividend reinvestment plans, whether it's, with commissions now at brokers being so low, the ability to invest $500 or $250 or $1,500 in a way, again, palatable amounts of money that you can put into the market. I like dividend reinvestment plans because, again, these are plans where you can invest directly with the company in two ways. The first way, and hence the name dividend reinvestment, is that instead of taking the cash dividends, you can take those dividends and reinvest them for you to buy additional shares of stock. Again, it's a way to automatically get money into the market, even at times when you don't want to, but you think you should. The other thing that's nice about dividend reinvestment plans is once you're in those plans, the minimum investments in those plans can be as little as $50 or $100 or $250. So they're not just great plans for people in this room, but they're really also great plans for your children and your grandchildren and people that, I talked to a group yesterday that was at a hospital, and it was a mixture of people and the ages, and I said, if you're 25 or 35 years old, now don't rub it into the person sitting next to you, but this is probably the greatest thing that could ever happen to you from an investment standpoint. You just got stocks at 45% off to start building portfolios. And again, if you're in that group, you got to figure out a way to take advantage of this. Yeah, you may not pick in a bottom, and I can guarantee you, you're probably not. But the bottom line is, there's that old saying, nobody rings a bell on Wall Street at the bottom. There isn't a town choir that comes out and goes, all right, everybody, time to buy. It doesn't happen. You've got to play the probability. So you got to figure out palatable ways to put money into the market. I think 403bs, 401ks, dividend reinvestment plans, mutual funds that allow you to set up automatic debit from your bank account where you can invest $50 or $100 or $500, some way to get in there to take advantage of that. The last thing I want to mention are, I mentioned I would give you a couple of stock ideas. So, okay, so you can wake up now and papers can rustle. It's tough out there picking stocks because, and I'm not telling you anything you don't know, because of this uniformity of declines. And you hear, and the few stocks that haven't been getting creamed are just getting this rush of money into them, which concerns me when things do turn, that those are going to be the stocks that really trail the pack. So we're trying to find somewhat of a balance between stocks that should have discernible earnings going forward, should do okay in that environment that may have an element of defense to them, but have also pulled back to the point that I think they offer pretty good values. And two stocks that kind of fall in that category are two medical stocks, actually. One of them is St. Jude Medical. The stock symbol is STJ. And Biogen, which is kind of a controversial pick in the biotech area, but one that we kind of like right now. And the symbol on that is B as in boy, IIB. So those are two stocks that we would take a look at if you were looking for some stock ideas. If you like the concept of drips and you want to invest in drips, there are a number of drips out there that have direct purchase plans where, the traditional dividend reinvestment plan always had this catch-22. You couldn't invest directly with the company until you were already a shareholder of the company, which begged the question, well, how was I going to do that? Well, most people didn't want to go to their stockbroker and go, you know what, I'm setting up to make a pretty big buy here. Give me 3 shares of PepsiCo. You don't want to do that. Companies understood that, so now there are more than 600 companies, both U.S. and international ADRs, that allow any investor in this room to go directly to that entity to buy stock directly from the company. I mean, you can do it in companies, more than half of the stocks in the Dow Jones Industrial Average allow you to do that. The Procter & Gamble's, McDonald's, IBM's, GE's, those stocks. Anybody in this room can buy them directly, the Disneys of the world. If you like international stocks, you can buy China Mobile. You can buy Baidu, which is kind of the Chinese Google. You can buy Vimpel Communications. Vimpel Communications is a Russian cellular telephone company. I don't know, if cellular telephones in Russia, are two Campbell soup cans and string. But if you like Vimpel Communications, you can buy that. So there's a lot of opportunities to do that. In that world, if you're looking for some stock ideas where you can buy stocks directly, I think it's kind of a crazy stock, and it's actually one, that we don't have the nerve to put in client portfolios. But if you're looking for kind of a real interesting speculative play, excuse me?
Bronco busting?
I'm not familiar with bronco busting. Oh, is that a term? I'm not familiar with that. Oh, well, no. Well, you could be a wildcat to do it. No, it doesn't have to do with oil. It's Baidu. That stock's gone from, I think, about 300 to about 100. And they're growing by leaps and bounds. And search over there has it really been as developed as it has been here, and on the whole corporations participating. The symbol is BIDU. And again, it's a stock that is pretty spicy meatball, but it's one that's has just gotten hammered, and one that is kind of interesting to me. I appreciate the opportunity to speak to you. I'll be glad to take some questions now from the audience. And thank you. Yes, right here, sir.
Talk about what investors should be relying on or ignoring with regards to media.
In this age of, and I've got a journalism degree from Northwestern University, from the Medill School of Journalism. So I was kind of a media guy. I guess I turned my back on it over time. But media people got to fill space, whether it's airspace, print space, or whatever. So everything in this world has become magnified. I love watching CNBC, and they come across with breaking news, and it's, Henry Paulson got up this morning. It's breaking news, And I think a lot of that, if you sit there, there are a lot of people in my business that have that on in the background, and I don't. Because to me, it's latching on to things that will drive ultimately some maybe volatility on a short-run basis, but I don't think it has any lasting impact on what's going on. So, you can watch that. It's entertaining. I know, people in this room probably watch Jim Cramer, and they're all waiting for him to have his coronary one of these days and die on TV, which I'm not so sure would be the worst thing in the world. And it's entertaining, but the value, from a value standpoint of that, I think a lot of times for individuals it causes more confusion than anything else. I think at the end of the day, you have to have a process and a discipline that you follow as an investor. And certainly, I don't have the monopoly on that. My firm has a very disciplined approach. I can tell you the discipline hasn't worked very well in these markets, but nothing has worked very well in these markets. But we're not throwing out the process and discipline because historically it's worked well. And I'm not going to throw something out during a period that seems a huge anomaly to me. An anomaly is not the right word, but in a period when nothing is working. So if you have a disciplined process, and whatever that process may be, you're going to be way better off following it, especially if it served you well in the past. I know it's tough to do when it ain't working, but eventually it will again. It's a whole lot better than trying to go for the process of the day, because you're just going to be playing catch-up, and it just doesn't work well that way. Yes, sir.
My focus over the last couple of years has been on towards commodities, and you haven't brushed on those, but DBC hit a 52-week low yesterday. And what is your view on the future outlook of commodities? Particularly gold and oil.
Well, this has been, and this gets back to this notion of the uniformity of the selling. Usually stocks do badly, commodity, that's that whole notion of diversification, and it hasn't happened. And you've got gold. You had a lot of people flocking to gold because it was the thing to do when it was up about $1,000, and now gold's, what, $740? Somewhere in there, and that's probably gone down as much, if not more, than stocks in the last 3 months. Everything's gone down. Well, again, it gets back to kind of the mass liquidation, the mass deleveraging that we're seeing. I have no problem with owning commodities in a portfolio as a piece of a diversified portfolio, because I think at some point, and I don't know when, but at some point, diversification of those things will matter, and you will start to get differences in returns once we get through the kind of this forced selling period. The problem I always see with commodities, though, people don't go in for a little, they go in for a lot. You know, somebody who buys gold, that's all they own. You know, it's the classic gold bug. And the guy will go, you know, I got 95% of my portfolio in gold because, boy, gold is really going to do it. Yeah, you know, to have 10% of a portfolio in commodities, I think is fine. You know, as a diversification measure. And here, you know, and it's not a group that we've been money on right now. We were money on it in the first 6 months, and we've been horrible in the last 5 months for the energy stocks. We still like the energy stocks out there. I mean, you know, you got oil that went from what, 40 to 160 back to 50 in 12 months, 8 months. I mean, I just think when I look, yeah, oil profits are going to come down because of the price of oil, but those stocks, to me, seem to be priced at a point where it's not going to be hard for them to beat expectations. So, you know, I think some of those stocks are pretty appealing right now, like the Transocean, which is a driller, and I think Exxon, you know, is kind of the steady Eddie in the group, which really hasn't been creamed that much. Yes, sir.
I just bought a car made in Detroit.
I'm going to come give you a hug, okay?
I bought it 2 years ago.
Okay.
Should I sell it or buy another one?
We're talking about cars and not the stock, right? You know, and that kind of brings up the question of, you know, I've got this question quite a bit lately about, you know, to bail out or not to bail out. Is that the question? There are a lot of people that are probably smarter than me trying to figure that out. To me, it just seems that in a business environment where your wages on average are in the 70-plus range versus your competitors' wages are in the 40-plus range, I don't know how you run a business like that for profitability. Now, maybe they can, and maybe there's a lot more issues there, but to me, that is such a fundamental issue that unless you fix that issue somehow or change that issue, I don't know what giving more money is. Maybe you get lucky and you give more money without a change in that, and the market turns, the economy turns, and you catch a break. But boy, that's a lot of big ifs, and it wasn't like GM and Chrysler and Ford were cutting fat hogs prior to the current problems. So, you know, what I think is going to happen, I think, getting back to your question, I think car is going to be okay, because I think one thing that if the government wanted to bail out GM and Chrysler and Ford would be something along the lines of, I think there's going to be a bailout, to tell you the truth. To me, though, the issue is going to be, is it going to be pre-Chapter 11 filing or post-Chapter 11 filing? You know, they're going to get money. And my guess is if they were smart, part of that money, especially if they went into Chapter 11, would be warranties, for example, where you are guaranteeing warranties on these automobiles. Because, you know, one of the issues that comes up that people say, well, they can't go into Chapter 11 because people aren't going to buy a car from a car company in Chapter 11. Well, I got news for you. Whether you're in Chapter 11 or your stock's $1.50 or whatever it is, and you're sitting there today and you got to buy a car, are you really thinking that hard about, well, I'm going to buy the car today because they're not in Chapter 11, but boy, tomorrow if they're in Chapter 11, I'm not going to buy that car? No, you're not. I mean, for all intents and purposes, in the consumer's mind, the company's in trouble. And that's the question right now that I think a consumer faces, not whether they're going to file Chapter 11 or not. Whether I buy this car, is somebody going to stand behind it? So I think they can do those types of things. They can do it within Chapter 11. They have the ability to affect change on their wage scale and see, and then let what markets do and capitalism does, let the bondholders fight it out. They're the owners of the company at that point. If you want to deep six the shareholders, and I apologize if anybody has GM in this room, but if you want to deep six the equity holders, they're deep six now as it is. Let the bondholders fight it out and figure it out. Yes, sir.
What signs do we look for in the economy that are going to foreshadow, let's say, an improvement within the stock market?
Well, I think the question, actually, I would answer that is the reverse, okay? I'm not looking for changes in the economy necessarily that will tell me when the stock market's going to go up. The stock market's going to tell me that, when those changes are going to come. And they're going to tell me that ahead of time. What I want to see is, again, stocks in the stock market stop going down or absorbing negative news. I think that's the chain reaction, not what happens in the economy, ergo this happens in the stock market. Because as we've seen, stock market is down 45%, and it was down dramatically prior to this latest round of awfulness that we've gotten, indicating that we were going to get that. So, and again, keep in mind its expectations. So if you're waiting out there for a company's earnings to start to show growth again, you may be waiting a while in some cases. But if you see companies that are coming out with earnings that are beating expectations, or you see economic data that comes out and beats expectations, and the reason why, again, to get back, why it moves off these types of declines are so explosive is partly because, let's face it, who in this room has real high expectations of anything on the economy? We have zero expectations, We have negative expectations. So the hurdle isn't real high. And so that's what happens generally when you come out of this. Everybody has such bleak expectations, and you get this piece of data that's terrible, but you know what? It wasn't that terrible. It wasn't as terrible as I thought. You see a little thing, and then you get another piece, and it starts building on that, and that's when you start to see. So that's what I would see. Yes, sir.
I spent about a month in Europe in late September and early October, and the Europeans blame the whole financial thing that they have on us. Is it really all our fault?
Well, listen, nobody was holding a gun to their heads to buy the securitized debt that they did. They fell prey to the same thing everybody in this, These markets are driven by fear and greed. Right now it's a lot of fear. Back then it was a lot of greed. So, yeah, they can blame us all they want. And, yeah, are we still the tail that wags the dog internationally? That's obviously up for a lot of debate, but we still matter. So, but I can tell you that there have been times when you haven't had such a tight correlation, not just in economic things, but in market things between us and what's going on now. And there has been, that the whole notion where they think the world's flatter, it's smaller, it's interconnected or whatever. What matters here matters there and vice versa. I think we're going to come out of it sooner than they are. I think their problems, I don't know if they've only just begun, but I think they're going to be in there for a longer period of time. Yes.
I'm just getting kind of a gestalt from this, but
oh wow,
that you're saying get stocks. In a sense, it's like if I look at these charts that you've given us, this seems like a pretty juicy opportunity.
Yes, and let me with a qualifier of you got to figure out what the element of defense makes sense for you to be playing right now.
Right, but also markets tend to reflect mass hysteria. I mean, another word for expectation.
Sure.
Right. So,
and they've been reflecting
you're kind of saying to all of us,
I have been reflecting.
If you don't get into the market, you're not part of it turning around. So my question becomes, let's say you have, investment-wise, let's say you have property you own outright.
Okay.
Which is a form of equity. Do you think that it would be smart right now in this market to take credit while we're doing a credit crunch, or take equity out of owned property, completely paid for, and put it into the stock market to the point that's palatable to you? I mean, would you recommend that to a client?
I probably wouldn't. No, I wouldn't. Again, there's a lot going on out there, and that notion of where we've come out at the 25 to 35% is, trying to take into account market's cheap. I think there's opportunities there, balanced with market doesn't seem to care. Had I talked to this group a week ago, my talk wouldn't have been any different. Market sure has been a lot different in that week. And that's partly why, I think there is an element of playing some defense here just because. But I think, is that 100%? I don't think so. I mean, for our client, we still got 75% of their assets in the market if you're an all-equity guy. So we still got a pretty hefty bet on stocks coming back. Would I do things that would, potentially lever up my situation? Or would I shift? Part of your question is really an asset allocation question. You got X devoted to real estate. Should I, and I'm really maybe you're really underexposed to the stock market. Maybe the answer I would say would be different if you had 0% of your portfolio in stocks and it was all real estate.
That's correct.
Maybe I have a little bit different feeling there. I'd have to look and see, okay, if we do this, what happens to your personal balance sheet? But yeah, if you're 0% in stocks, to shift to take advantage of this, I don't think that's the worst thing in the world. Yes.
Romney today has made the comment that they need to let Detroit fail and bring the average working salary down to that of Koreans or the Japanese or whatever. How, if that's permitted and all of these contracts are broached, how is that going to affect the stocks, because of the ramifications through the whole economy of these people not only losing their houses, but the basic, you are taking this fundamental salary basis and dropping it. How is that going to affect stock?
Well, that is not going to be a plus for the economy. And I don't mean to be flippant about that. But the question would be, again, this notion of discounting that. And I will make a point. If you knew that extending money was going to work, it makes it a whole lot easier decision. I think, the point of this is like, do you feel the pain now or do you feel it later? And I think as an investor, as bad as it is, if I'm going to feel the pain, I want to do it now and get done and get the bottom. I think a lot of times, getting back to all the machinations of what the government is doing. I mean, you can argue, reasonable people can have big arguments whether what the government is doing is right or wrong. Keep in mind, our economy is driven by two things. It's driven by credit and confidence. So anything that can be done to boost confidence and to unlock credit is probably a good thing in this type of environment. I think where people have been angry have been the way that the government has gone about doing this. We go to Capitol Hill, a month and a half ago, we want $700 billion and we want to do it and we want to buy these toxic securities back. 3 days ago, whenever it was, well, you know what, we're not going to do that anymore, we're going to do this. And maybe there's perfectly good reasons to change course, but it doesn't necessarily instill a lot of confidence in investors or the market. And my point on yours is that I don't know how that industry survives under its current situation.
It's not the industry. I'm talking about the ramifications, because the automobile workers, and I don't know the numbers, okay, but say the average automobile worker is making $25 an hour.
Okay.
All of a sudden, he's...
Well, that's okay.
I'm just taking this as an example.
Sure.
And all of a sudden, he's dropped to $10 an hour.
Right.
Okay. A lot of other jobs are pegged off of what the automobile worker is making. Maybe the guy in the tire company is making that. All of a sudden, they're dropped. What is the overall effect?
Sure. It's in the short run, it's probably not going to be very good. But again, my point would be, if that person still has a job, that's going to have. Well, you're going to have.
All their credit all will come out of that.
Well, I think you could. Well, we're trying to figure out, how the government can get us out of it, and I'm not sure that's the solution. I think you kind of let the chips fall where they may. The solutions. I think sometimes we're losing our collective will as a country to endure pain. And I know that sounds an awful thing to say, but I had a client the other day, and again, I apologize if I'm on my soapbox and I don't mean that, but I had a client the other day who said to me, I just wish I had a president who could put his arms around me and tell me everything's going to be okay. And I about fell out of my chair. If we're looking for those types of solutions from the government to ultimately solve all of this in a pain-free way, I think we're kidding ourselves. And, listen, I have a job, at least today. And so for me to sit here and talk about those types of things, I feel a little hypocritical on that. But it's not going to be pretty, but the question, I think, is it going to not be pretty now or is it not going to be pretty later? And I guess I'd rather have it not be pretty now. The other thing about that, too, in terms of letting it go under, I mean, in a Chapter 11, there can be a restructuring and can be jobs that are salvaged. I go back to what happened to Lehman Brothers. When the government didn't bail out Lehman Brothers, you could argue maybe they should have or maybe they shouldn't have. But what happened? Well, when it went into Chapter 11, the bondholders sat there and they started to sell off pieces. And they sold off a huge chunk of it to Barclays Bank, who came in and bought a big chunk of it for a song. They kept most of those workers. So, I mean, if it's all about jobs, there is still maybe a way out within a restructuring to at least preserve some of those jobs. A pure Machiavelli capitalist would say, you know what, if resources will find the place that they're supposed to find, and if we're supposed to be building cars in the United States, the resources will find that. And if we're not, we're not. And the government can do whatever the heck they want, but they're only going to prolong the agony. I can take one more question.
Last question. Brief question.
Oh, this is power, isn't it? One last question. Yes, sir, right there. Yeah, you had a question, right?
Yeah, you mentioned, the flat world, efficient market theory, all this, what should be
Crap.
non-correlated, not being non-correlated now. Do you think we need to relook, quote, modern portfolio theory, which is only 50 years old, and some of the other metrics that maybe now we're a flat world that doesn't work very well right now?
I think that, yeah, I think there certainly is going to be a re-examination of those things, because in this environment, non-cash assets didn't work very well in terms of diversifying a portfolio. Do I think, though, that re-examination, I think, can be healthy? But do you throw out things? And again, I'm sure an economist could argue, whatever happens in a 50-year period, you don't have enough data points to determine whether it makes sense or not. But I live in the real world, and I got to, all I have is 50 or 60 years. I don't know what stocks were doing back in King Arthur's court. So I got to live right now, and so I'm a little bit reluctant. I think a re-examination is fine, but I think to throw out those things because of this period, I think would also be a mistake, because I need to have something better to throw it out for. And you need to demonstrate that to me. And just simply demonstrating that in a 12-month period, this has happened, I can't really discard everything else. I think there are elements of that. I've been saying for a while that the correlations between international markets and U.S. markets had been tightening up pretty closely. And that certainly has been the case here in this period. But up to this period, for a 5-year period, you had international stocks that were off to the races versus U.S. So things did work pretty well until they came off the wheels here, but nothing is working right now. So I don't know if you just simply throw that out, and I would be reluctant to do that. Listen, everybody, thank you very much. Their mortgages are underwater. They can't pay their mortgages. They're walking away from their mortgages. That concept of jingle mail, if I have any bankers in the room, you know what jingle mail is? Where you get the envelope in the mail, and what it is, it's the person keys to the house, because in an age of non-recourse loans, why should I sit there and I got a house, I owe $700,000 on a house that's worth $400,000. What's the rational, logical thing I'm going to do? Here are your keys. So what happens is all those securities out there that are based on these mortgages, they start to lose value, and they're losing value quickly. That sets off a massive chain of events. Well, one of the chain of events it sets off is, remember, these mortgages are on banks' books. And banks have capital requirements. So now their capital is shrinking because of these things. What does that mean for banks and other entities that have capital requirements? They got to get capital. Well, how do you get capital? Well, you go borrow it from somebody. Well, who am I going to borrow it from? The guy down the street's in the same boat I am, and he usually is the one that gives me the money, and he's not giving me the money right now. And I can't get it from him, and I can't get it from him, so what do? Well, you get into a situation where nobody's loaning out and everybody's hoarding. So what else can you do to try to get your capital back? Well, I go back to the people that I loan money to, based on collateral, based on these things, that's now declining in value, and I say, you know what, I gave you the money based on this value. This value ain't the value anymore. I want my money back. So that sets off a chain of events, and that's why you're seeing such entities as investment banks and hedge funds and these entities that run their businesses on tremendous amounts of leverage. In the case of a Lehman Brothers, for example, one of the things that's interesting about what happened to Lehman Brothers is what happened to it so fast. But if you're a business that's basically run on 15 to 20 to 1 leverage, where for every capital dollar you have, you've gone out and borrowed $15 or $20 to run your business, you are running a business based on promises and the friendliness of your local banker or loan person, somebody giving you money, maybe the credit markets, maybe investors. Everybody is shut down at this point. Those wonderful days have passed when you were making all that money in the market in the 80s and in the 90s. You're welcome. But you're seeing selling now, getting back to that point. The uniformity of the selling I've never seen, and I've been doing this for 26 years. How do I see that uniformity? Look at any asset class you want to look at, particularly across equities. You look at large cap stocks, mid cap stocks, small cap stocks, value stocks, growth stocks, U.S. stocks, international stocks. Everything is down 35, 45%. Everything. It's remarkable the tight correlation of returns across those asset classes. You know, the old adage is, somewhere there's a bull market. There ain't been a bull market anywhere this year. There's been no place to hide. You look at commodities. They've been getting creamed. You know, you look at the bond market. It's not down 30 or 35%, but you've got short-term bond funds that are down 9%, 10%, 15%. So everything is just getting hammered this year. And one of the reasons everything is getting hammered is because of, to some extent, this forced selling that's going on in the market. There's great deleveraging. There's great unwind. So that's one aspect of what's brought this selling pressure into the market. Now, keeping this analogy going, as I mentioned to you, one of the things that happened to cause all this was a decline in housing prices. Well, the decline in housing prices has a huge impact on everybody in this room in terms of the wealth effect, how you feel about your wealth, how much money you have. And you've got a decline. And the other thing is, and I'm not pointing fingers at anybody in this room because I'm sure everybody in this room, nobody has done this, but you know, there are a few people in the United States that actually refinance their homes a time or two or 12. And during each of those refinancings, what were they doing? They were pulling money out. And what were they doing with that money? They were funding consumer spending. Well, that game's over. Not entirely over, but it's over to the standpoint that everybody can play the game anymore. So consequently, you have consumers that aren't spending right now. Well, consumer spending is one of the biggest drivers of the overall economy. So if you don't have consumer spending, what's that doing to corporate profits? Well, we're seeing what's doing to corporate profits. You've got, you know, the Circuit Cities of the world filing Chapter 11. You've got the Best Buys of the world saying, we've never seen an environment like this. You've got tech. So now what do you got to do when the bank's calling the loans and you have to deleverage? You sell. And you don't care what you sell. You know, when people tell, and I was having this conversation earlier this evening and said, boy, it looks like some of the stocks that are really getting whacked around the most are some of the best companies out there. Companies that you know aren't going bankrupt. Companies that are solid companies. They're still making profits. And you know what? Nobody cares. And the reason is, in an environment where you have to sell because you got a banker staring at you, or you have investors lined up your door that want their money back because they're not pleased with their performance, and you got to sell, you're not going to care at what price you're selling. And the first stuff to go is the stuff that can sell. So, and oftentimes, the stuff that can sell is the biggest, largest, bluest chip, deepest markets, and that's what's getting pitched. So now you have this tremendous deleveraging that's going on in the economy. You've got everybody that's eschewing debt. They're getting off debt. They're getting off debt because they're being driven to get off debt, and they're selling. And again, it's fairly indiscriminate. And one reason you can tell this notion of indiscriminate selling, this notion of proportional selling, if you will, is that if you look at the uniformity of declines across asset classes, I've never seen anything like it. And I've been doing this since 1926. I came down and drank the water in Florida down here and got the... I've been doing this since 1982. It's kind of interesting. I saw in here the notion that, you know, a person today is going to have about 900 jobs in their career. I'm a rarity. It's the only place I've ever worked. I've been there for 26 years. I started my second day on the job, and I look around the room and see I'm not the only one here that's got gray hair, so this may resonate with some people. I started on the job August 16th, 1982. On August 17th, 1982, it was a Tuesday, I came into my office and the Dow Jones Industrial Average went up 39 points. Big deal, right? Well, it was a big deal. The Dow at that time was 792. So, went up 5%, and some people peg the beginning, literally, of the bull market, the great bull market of the 1980s and 1990s, based on that day. So, when all of you were thinking back, that was driven by easy credit and a push in this country for home ownership. Why do I say that? When you look at mortgages in 2002, the total percent of mortgages that were subprime mortgages of all mortgages was 2% in 2002. 4 years later, it was 30%. 30%. So what you had, in effect, was this huge growth in mortgages made to, for lack of a better term, credit-challenged individuals, or individuals taking advantage of those opportunities because they were available to them, all based on the premise that my housing value is going to continue to rise. So what Wall Street did in its infinite wisdom is take these subprime mortgages, package them up. After all, if one of these mortgages might be a little bit risky, but boy, if I package 11 or 12 of them together and slice and dice them up, well, all of a sudden that's diversification. And what one was bad, 12 of them are great. And the credit agencies do what? They give them AAA ratings. Well, if you think about it, that's not really what diversification is all about. Diversification means you take non-correlated assets and put them together in a portfolio, or assets you hope are non-correlated, and we're finding out maybe diversification is a little bit flawed this time around too. But ideally, you take non-correlated assets. Here, it's kind of like saying, listen, I got one bad baseball player, and that's a bad thing, but boy, if I can stick 8 bad baseball players together, and trust me, I'm from Chicago, so I've seen plenty of 9 bad baseball players. So you put 9 bad baseball players together, and boy, we got a great team. Well, doesn't quite work that way in baseball, and it didn't work that way when you were securitizing these subprime mortgages. So what happens is Wall Street takes them. They got a great product, AAA rating, great yields in low yield environments, boom, shooting them off all over the world, selling them everywhere, not just in the United States, but literally all over the globe. So you got banks buying these things. You've got insurance companies buying these things. You have hedge funds buying these things. You have investment banks owning these things. So now they're out there and they're on everybody's balance sheets. So now what happens? The bubble bursts. Housing values start to decline. People who bought are now finding that Thank you, Carol, and thank you, Ken, and the Institute. It's nothing like getting a build-up like that and then have to come up and tell you. So, as Carol mentioned, I live outside of Chicago, and when I got up 2 days ago, there was a foot of snow on the ground. So when I tell you I am happy to be here, I truly mean it. I look around the room and see, boy, the power of free food in a free-falling market. That is a powerful draw, isn't it? What I'd like to talk to you about tonight is the stock market and your investments. And I'm going to do it in about 4 pieces. The first piece is I'm going to talk a little bit about how we got to where we are, because I think it's important to kind of understand. I think a lot of us feel like we've been run over by a freight train and didn't even know where the freight train came from. And I think it's also important to kind of understand the backdrop of how we got here, because partially we're going to have to work through that to get out. The second piece of it is I'll give you an idea where we are today, what I am seeing, what I think is going to happen. I'll talk about a path out, things that I think we'll need to see as investors in order to give me an idea of that $64,000 question, has this market bottomed? Finally, we'll talk about what I think individual investors should be doing. And then finally, I'll give you a couple of stock ideas. Now, I've done this enough where usually when I get to the final stock ideas, paper comes out, people wake up, and one of these days all I'm going to do is sit up here and give you, stock ideas for 50 minutes. You're not going to get that tonight. You're going to have to endure a little bit different till we get to that. So how did we get to where we are today? And again, this is not meant to be political. It's not meant to finger point. Trust me, there's enough blame to go around for everybody. But in a nutshell, as I see it, we got to where we are today. First and foremost, this has been built on the back of a housing bubble, pure and simple. A housing bubble